Seems like it was just yesterday that the Tax Cuts and Jobs Act went into effect, but now we're already planning for its end. This is the Issues Watch podcast. Hi, I'm Jeff Kazerman, Vice President of Government Relations at the New Jersey Society of CPAs, and welcome to the Issues Watch podcast. The Tax Cuts and Jobs Act of 2017 was a significant overhaul of the United States tax system. However, many of those changes are set to expire at the end of 2025. What will replace the expiring provisions? Well, that's very difficult to say right now because so much of it will have to do with who wins the 2024 races for president and Congress and whether there would be any bipartisan cooperation, something we obviously haven't seen much of in a long time. So with all this uncertainty, what is the CPA to do? How should they be advising their clients and employers? Today, I'll be talking with NJCPA member Joseph Andolino about this very issue. Joe is a tax director at Smolin, Lupin and Company, where he specializes in finance, legal, and tax engagements with an emphasis on international taxation. Welcome, Joe.
Morning, Jeff.
So tell us, what are the most important provisions of the Tax Cuts and Jobs Act that will expire in 2024 and 2025, and let's start with the business taxes first and then look at individual income taxes.
24 really has some continuation of some very important provisions that expired and will continue to expire. So let's start with R&D expensing, okay? Starting last year and continuing indefinitely, taxpayers cannot deduct their R&D costs. And while that was a big surprise in the initial year, because now we're amortizing over basically 6 years, I think taxpayers are getting used to it. And in New Jersey, thankfully, the New Jersey law was changed. So if research is conducted in New Jersey, there is a reversal of the federal rule. So what that boils down to is it makes sense for New Jersey manufacturers to do their research in New Jersey. Bonus depreciation, of course, phases out over time, and in 24, it continues with a 60% allowance, expiring at the end of 26. This provision alone was responsible for $470 billion in tax losses when it was in the law in 2017. So this is a big and a significant item that taxpayers have to be aware of. There's a variety of biodiesel fuel and aviation credits that expire in 24 that are sort of unique to those industries, but I'm just mentioning them to be complete. So then moving into 24 and 25, the employee retention credit claims have to be made by April 15th, 24 for the 2020 claims, and for the 2021 claims by April 15th of 25. So the law is actually expired, but the claims are due in 24 and 25. That particular provision has been very controversial, but for taxpayers entitled to it, it's been a significant benefit. Moving into 25, and again, sticking with the business side of things, I think we come to perhaps the biggest and most significant expiring provision for family businesses. That's the qualified business income provision, QBI, where you get a 20% deduction on QBI income, and it basically drives the top rate from 37% to 29 and change. It's extraordinarily significant, and it expires at the end of 25, so you will no longer get it in 26. And I think it's kind of worth mentioning how this came about, Jeff, because when you think about it, C Corps got a permanent reduction in the 17 Act from 35 to 21. And almost as an afterthought, if you read the congressional record and the history of the legislation, the Congress said, oh, well, what are we going to do about small business? It's not fair just to have a rate reduction for big business. Let's talk about the pass-throughs. And the QBI rule was introduced, yet it expires, okay? The C Corp rule does not expire. I mean, that's something that taxpayers really need to plan for because it's been extraordinary. In my professional lifetime, you know, you really don't have a lower tax rate on business than that which is provided with the QBI for pass-through entities. And then moving on, the foreign-derived intangible income goes down from an exemption of 50% to 37%. Same thing with GILTI. So for exporters, it's going to be less beneficial. And for the GILTI, global intangible low taxed income, foreign entities, the exemption goes from 50 to 37. It's going to be more expensive to do business offshore, okay? Again, this is 25. The work opportunity tax credit expires for targeted taxpayers. The business loss limitation of 250,000 expires, which is actually beneficial. You can go back to what one could have previously deducted. And then, even though you didn't ask me, I'm going to go to 26 because there's QBI, the qualified opportunity zones, QOZ, they just simply expire. So whatever capital gains were deferred in the qualified opportunity zone are taxed at the end of 26. And those were my big 10. Let's see if I had another one. Yes, I do. I have a cheat sheet here. Kind of an arcane rule, but for controlled foreign corporations, the look-through rule for related companies goes away, which means, again, subpart F income is likely to be more of a problem for those taxpayers with overseas operations. You can no longer look through related parties. That's the business side. You want me to move right into the individual side, or you want to, you know?
No, that's good. Let's move into individual.
There's really not a lot expiring on the individual side in 24. 25, there's 30 something. I talk about the top 9 because I think they're very significant for most taxpayers. The SALT limitation of 10,000 actually expires, which means at the end of 25, so therefore in 26, there is no limitation on state and local tax deductions. However, that's offset with a number of other provisions. The personal exemption is reinstated, another positive. On the negative side, the rate brackets are adjusted back to 17 levels. So if you look at the actual tax rates and the brackets, if you look at the top rate now of 37% for married couple filing jointly, I think it started at 600 and it's now at like 730 or something like that with inflation. That all goes away and we go back to the 17 law, which starts, you know, obviously low, but goes all the way to 39.6. And the brackets are more narrow, meaning you're going to be in a higher tax bracket quicker. And that's going to be quite an offset. The standard deduction goes back. If you've noticed on your tax return for many taxpayers, they really can't itemize because you get 27,700 automatically. And with the SALT limitation capping you at 10, many taxpayers can't get over 27,700. That all goes away at the end of 25 and go back to what the rule was in 17. And the standard deduction was about 17,000 and it's not indexed. So that's going to be a big change. On the positive side, if you've noticed, you can't deduct excess itemized deductions over 2%. That rule goes away. Now you can. So at the end of 25, union dues, tax preparation fees, attorney's expenses that were previously deductible, that rule comes back. And probably the most significant of all is the estate and gift tax exemption, which, as you know, is at 13.6 million per person right now. It goes back to 6.4, which is what it was in 2017. This is an extremely significant item, and there's an awful lot of planning going on as we speak to make changes now to transfer wealth from generation to generation with the higher exemption. Absent some congressional intervention, that is just going to happen because the law expires. The charitable contribution limit reverts to 50% from 60%. Could be significant. The mortgage interest deduction, which now is capped at mortgage amounts of 750,000, goes back to the prior law, which is mortgage interest on $1 million plus 100,000 on home equity line of credit. As interest rates go up, this is a significant amount. The other, I think, most interesting is the AMT exemption threshold will be reduced by 25% on alternative minimum taxable income over $1 million. And this is interactive. So yes, you will get your state and local tax deductions after 25 without limitation, but also you have the possibility and frankly the probability that that's going to be subject to alternative minimum taxable income where the deduction isn't allowed and the exemption amount goes down. So I mean, to put it simply, Jeff, you really, as an individual taxpayer, need to push your pencil around and get with your accounting firm and do the calculations to see how these changes affect you.
Yeah, it sounds like quite a lot. Now, as I'm sure you're aware, the salt deduction cap of 10,000 has really stirred up a hornet's nest in New Jersey ever since it was passed. From what I recall, the actual impact on maybe 50% of New Jerseyans was positive or slightly positive, and then on another 50%, it was negative. But certainly, those who it negatively impacted, have created a stir. And the same thing has happened in other northeastern states and other states where property taxes are higher, which tend to be blue states, and there was that whole political dynamic to it. What do you think is going to happen with that when and actually we can look at this further with my next question, but I'm sure that's going to be very sensitive to who wins the elections in 2024 for the presidency and the House. But what do you foresee happening with that?
Yeah, I mean, that's a great question. As you know, first, let's just start with the Congress and the makeup of the Ways and Means Committee. There are some New York City area members that are on the committee now that are much more sensitive to the issue regardless of party. Okay, there's also a Republican member from California who's announced, just because of practical consideration, she wants to get reelected. If you're from California and you're a Republican, that doesn't mean that you're not in favor of getting rid of the SALT limitation, because you've got constituents who care about it. So it's not just a party thing, as you alluded to, it's what state you're from. Look, the SALT limitation alone is very expensive. The thing about tax bills that's worth going back a step and talking about is you have the balanced budget amendment. And what that basically means is every bill is supposed to be revenue neutral. There's a statute that mandates that. And then they have to go to the Office of Management and Budget and ask them to, quote unquote, score the bill. In other words, if we end the SALT limitation, what's it going to cost? Then there's a debate whether you do static scoring or scoring with behavioral change. So, the question is, can people do something about the SALT limitation? You can move, I guess, and go to a state with a lower property tax. That particular bill is going to, in other words, the elimination of the SALT limitation is going to be very expensive. So what'll be interesting is, yes, the political dynamics will come into it, but I would suggest, even if you had a Democratic victory with a Democratic House and a Democratic Senate, in other words, single party ruling, okay? I don't think it's easy to pull off because it costs so much unless you're willing to offset it with something else. The real key is the offsets. What are the offsets? You have to put together a package. And putting together a package, Jeff, as you know, because you're a legislative guy, it requires compromise, and there's not a lot of compromise in the U.S. Congress right now. So if I were a betting man, I'd say the limitation will expire, and so will everything else, plus and minus, unless something really, really significant happens. And I don't know what that would be, actually.
Okay, so you're saying regarding the SALT cap, that most likely, most likely, even in a Democratic controlled Congress and the presidency, it will expire.
Correct.
Okay, all right.
Is it scheduled to?
Right, right. And they'll have to figure out how to come up with that money.
The other things that don't expire as well, which are negative, so it could wash. It depends,
Right. I got it. So we started to get into this, but let's look a little bit more closely at the impact of the presidential and congressional races that will be decided in November, and what kind of impact that can have on all these expirations. So let's look at a few different scenarios. Supposing the Republicans do real well and they pick up the presidency and full control of both houses in Congress, what might that portend?
Well, you would think if that were to occur, they would want the guts of their 2017 act to continue, right? So I would think if that happened, they would, let's say, rekindle the SALT limitation because it brings in so much revenue. It suits their political aims, right? Because as you said, realistically, it impacts most of the blue states, not many red states, and that would enable them to continue other provisions like the low rate, the QBI, which is set to expire. One would think they would continue that, right? Because small business is at the heart of growth, and they are pro-growth. They're also bring things home to America, right? I mean, their idea philosophically is let's manufacture in this country. Well, to do that, you would continue some of the international provisions. In other words, we talked and alluded quickly to the 50% exclusion for a guilty global intangible low taxed income going down, they would allow that to go down. Okay, but you would think have the export relief, which is in the same section, stay up at 50%. We want people to make things in this country and export it to the rest of the world, kind of reverting to America post WW2, right? And those are the sorts of philosophical things you would think would happen if they really have control of the Ways and Means, the House, the Senate, and the presidency, and if it's their biggest priority. I would think, with two wars going on, a potential impeachment, somebody maybe on the ballot, not on the ballot, there's other things. But, I don't think it's a slam dunk, Jeff, if they get that power, it's the first thing they do. They have other concerns. As you know, Trump was elected and took office he was elected in 2016, took office in January, right, of 2017. The bill didn't get completed until the end of the first year that he had total power. And to do that, he had to keep Congress home between Thanksgiving and Christmas and exercise a lot of discipline, and that's hard to do. Tax bills don't happen often.
Right, right. Yep. So, and so let me ask you the same thing. If the Democrats should sweep the presidency and Congress, what could that
I think
portend?
the reverse would be true if they had the authority and this was their, you gave them the authority. If this is their first priority, I think the reverse would be true, realistically. The SALT limitation would be gone. The rates would continue to, the real philosophy, it's one of favoring work and income from labor versus income from capital. Okay, if you really dig into the Democratic, agenda, that's really at the heart of what they want. And they have issued a green book, which never really came to Congress, that talked about imposing a net worth tax on billionaires. That could be theoretically imposed. And we'll see the Supreme Court maybe speak about that in the case that's right now before them, about the one-time bring home tax. And we'll see if the 16th Amendment has anything to say about that. That you could also envision a capital gains exclusion going away, right? We want to tax labor like we tax capital. That's really at the heart of it. So if you think about that, and if they had free reign, I think that would be their agenda. Okay, obviously there'd be deductibility in full for state and local taxes because that's their political base and that sort of thing. But it's very difficult in any scenario to get everything that you want. It just is.
Yeah, yeah. I I foresee a lot of fighting and whatever, no matter how this all ends up, especially in this last scenario, which is what if there's a divided government, one party controls either one or both houses, and the other party has the presidency. I could foresee just everything expiring and nothing happening because they can't agree on anything. But what do you think?
I agree completely. That's the most likely scenario because a divided government is what we usually get in our republic. That's the way it works. We don't have the UK system where you have a prime minister because his party won most of the votes and they have power. We have a constitutional democracy. We can have divided government. We usually do. And the atmosphere in Washington is, I don't want to say toxic, but it's not one that gives rise to compromise. So inaction is the most likely scenario, which means our clients have to plan for these expiring provisions to happen. So you plan for the worst. If the best happens, you're modestly surprised, which basically means taxes are going up. Plan on taxes going up. Or there's going to be a giant sucking sound in the country in 2026 as cash is going from taxpayers' pockets to the government. And that's probably going to happen.
Right. I would agree with that prognosis. Not that I'm really watching Congress the same way you do, because I watch Trenton. I'm really, lobbying on state issues, but the dynamics are always similar, and that would be my prognosis also. So I have one last question for you, Joe. And we've touched on this, or you've touched on it. What should CPAs be telling their clients in advance of all these provisions expiring? What should they be doing?
Yeah, I think, in that time frame from, let's say, the end of October, because really the tax season now goes from, mid-March until October 15th, and CPA firms are generally very busy just preparing returns, complying with the rules, et cetera. That it's hard to get some people on the phone in that time period, right? We do our best in the time period that we're free. So let's say October 15th until the end of the year, clients and their tax advisors should sit down and forecast what's going to happen in the upcoming year. So the client's responsibility should be telling his tax advisor what changed. Are you still living in the same place? Are you still married? How about your income levels, up, down, sideways, you know, that sort of thing. And the tax advisor's responsibility is to gather that information, assess it, and let them know what we're looking at going forward. First and foremost, are you covered with your estimated tax payments so you're not going to have a penalty? Interest rate rises have meant that taxpayers get very unpleasant surprises when they're underpaid on their estimates or withholding. All of a sudden, if you're not at 110% or 100% in New Jersey of last year's tax, you've got a nasty amount of penalty, interest, because you're not paid up. So pay up. I mean, paying your taxes, frankly, is the most simple thing that you can do, but it requires planning, and that should be done.
Right, right. Okay, Joe, thank you very much for joining us today. I've learned a lot, and I'm sure our listeners have, and look forward to having you on again in the future.
That's great. Invite me. I enjoyed it very much, Jeff. Thank you for the invitation, the opportunity to speak.
Thank you. Thanks for listening and watching. For more news and events about state and federal tax developments, visit njcpa.org/hub/tax.